Welcome back. Okay, so have you ever wondered how a massive, globally dominant company can sell literally more products than ever before, yet somehow still see its profit margins shrink? Well, today's explainer tackles exactly that. We're going to look really closely at Nestle India. We're peeling back the layers of their recent financial reports to understand how global macroeconomic factors directly hit their bottom line, and honestly, more importantly, how they engineered a pretty epic comeback.
Okay, let's dive into this. Here is our roadmap for today. We'll start with the FMCG giant's growth, dive into the great margin squeeze, unpack the cost culprits, break down Nestle's strategic comeback, and finally look at their Q1 margin recovery.
All right, part one, the FMCG giant's growth. Let's just wrap our heads around the sheer financial scale of Nestle India. So for the financial year 2025 to 2026, Nestle India pulled in a staggering 23,072 crore rupees in revenue. Just let that number sink in for a second. That is a massive 15% year-over-year growth. Volume and value were basically up across the board. And this brilliantly illustrates exactly how they're doing it. This massive top-line growth is powered by those recognizable, everyday powerhouse brands that are probably sitting right in your pantry right now. We're talking Maggi, KitKat, Nescafe. In fact, fun fact here, India isn't just a participant in this, it is actually the largest market for Maggi globally. And get this, it recently became the largest market for KitKat globally too. Wild, right?
Now, what provides such incredible stability for them is their diversification. It's like a giant puzzle where all the pieces fit perfectly. Revenue is split really cleanly. We've got 33.4% coming from milk and nutrition, 31.5% from prepared dishes, which of course includes Maggi, 19.3% from chocolates, and 15.8% from beverages. This incredibly balanced net basically secures them a dominant market share across 85% of their entire portfolio. So by all conventional metrics, business was absolutely booming.
But here is the plot twist. Part 2, the great margin squeeze. We need to look at the stark contrast between those booming top-line sales and a shrinking bottom line.
Now, what's really interesting here is that despite that record 15% sales growth we just talked about, key profit margins actually fell from FY25 to FY26. Operating profit margin dropped from 21.1% down to 20%, and the net profit margin dipped from 16.5% to 15.4%. Basically, they were making a lot more money overall, but keeping less of it per item sold. It's a classic squeeze.
And this squeeze extended directly to their EBITDA margin as well, which dipped from 23.8% in FY25 to roughly 23% in FY26. It's honestly a pretty harsh reminder that even an FMCG giant with absolute market dominance just isn't immune to external economic pressures.
So why did this happen? Let's get into part 3, unpacking the cost culprits. We need to look at exactly what hit their supply chain. The real culprit here boils down to severe commodity headwinds. First off, edible oil prices remained highly elevated all over the globe. Second, milk prices spiked, which, remember, directly hits their absolute largest revenue segment. And third, unseasonal rains completely hammered both the quality and the quantity of the Indian wheat crop. And why does wheat matter so much? Well, it's the core ingredient for their absolute flagship product, Maggi.
And just to be super clear on the terminology, commodity headwinds are basically negative external economic or environmental factors that drive up the cost of raw materials. So these aren't just numbers on a spreadsheet. We're talking about geopolitical developments driving up freight and energy costs, combined with unpredictable weather impacting real crops. It basically meant Nestle had to shell out significantly more cash just to manufacture the exact same products.
But they didn't just take it lying down. Part 4, Nestle's strategic comeback. This is how a giant actually fights back against rising costs.
Faced with soaring commodity inflation and crazy high freight costs, the easiest solution is always just to drastically hike prices for the consumer. Just pass the cost along, right? But Nestle actually views aggressive price hikes as an absolute last resort. Instead, their comeback strategy relied on 3 main pillars: pushing what we call premiumization, penetrating new markets for volume expansion, and really doubling down on operational cost efficiencies.
So the crucial point is really how they executed that premiumization piece. Nestle made a super aggressive push into higher margin out-of-home segments. We're talking specifically about those premium Nescafe setups you see in offices and commercial spaces. In fact, India remained the largest market for Nestle's out-of-home business across their entire Asia, Oceania, and Africa zone. This generated volume-led growth with much better profit margins to help offset those raw material costs.
And they applied this premiumization concept across their entire portfolio through some brilliant strategic partnerships. Think about it. Whether it's integrating KitKat into traditional Indian sweets for the festive seasons, or partnering up for something like a Burger King KitKat BK Fusion dessert, these aren't just fun little marketing stunts. They are highly calculated moves to command premium profit margins without losing consumer trust by, just abruptly hiking the price of a standard chocolate bar.
Which brings us to the final chapter, Part 5, the Q1 margin recovery. Let's see if this whole strategy actually worked. Well, the results really do speak for themselves. According to the chairman and MD, Manish Tiwari, the accelerated operational cost savings absolutely worked. Not only did they completely recover their margins, but they actually achieved a highly healthy EBITDA margin of 24.2% in Q1. And this was alongside a massive 25.4% top-line sales growth. They literally beat the squeeze.
And this kind of incredible financial resilience gives Nestle immense confidence for the future. Actually, it gives them the confidence to plan a massive capital expenditure investment of up to 5,000 to 6,000 crore rupees over the medium term. Funded primarily by their own internal cash, they're going to use this massive amount of capital to ramp up both existing and brand new capacities pan-India across their entire product portfolio. Which leaves us with this final thought. We've seen exactly how global weather and commodity prices can squeeze a giant, and how strategic premiumization and efficiency can fight back to recover those margins. But as Nestle prepares to deploy up to 6,000 crore rupees in nationwide expansion, we kind of have to ask, in an increasingly unpredictable world, can strategic premiumization truly outpace global inflation for good? It is a fascinating corporate battle between strategy and economics, and it's definitely one we'll be watching closely. Thanks so much for joining me for this explainer today, and as always, keep questioning the numbers.